Okay, welcome back to the second clip on chapter 3 here. Okay, we were just looking at the various activities, the three categories of activities in the statement of financial cash flows. And as I was saying, these activities are in line with the three financial management decisions that we have seen in chapter 1. Alright, so let's continue. Alright, now what we are going to do here in the next slide is to derive, as the statement says here, the slide says deriving the statement of cash flows equation. Alright, so what we had, this is similar to what we have done in the previous chapter. Okay, we take the balance sheet identity first, which is assets equals to liabilities plus equity, and then we expand each item, assets into current assets and net fixed assets, liabilities to current liabilities and long-term debt, and equity to common stock plus cumulative retained earnings. Alright, and we have this equation here. This is what we have covered earlier. That's nothing new. Alright, then what we have said, if the balance sheet identity is true, and it must be true, okay, the change in these items must also be true. It means the change in assets must be equal to the change in liability plus the change in equity. Alright, therefore, since equation 1 is equals to equation 5, okay, we have expanded 1 to 5. Therefore, we can expand equation 6 to equation 7. It's basically this equation, but we have this change in. This delta is change in current assets, change in net fixed assets, and so on. That's what we have done. Then we continue. This is what we have done previously. It's not new. Change in cumulative retained earnings is equals to retained earnings, and we know that retained earnings is equals to net income minus dividend. Alright, so we replace this into the earlier equation, which is equation number 7, and we have this equation number 10. So this is not new. We have seen this in the previous chapter when we try to derive the cash flow statement. The cash flow statement, the statement of cash flows are slightly different. Okay, so from now, but beyond this, we are going to diverge slightly. It's not the same as what we have done in chapter 2. Alright, now we are going to expand this further, this equation number 10 further. First, we are going to expand this change in current assets to two components, which is change in cash plus change in non-cash current assets. Okay, why do we do this? Because the intent of this statement is to see what the activities do to the cash balance. So we separate this cash balance from the current assets. Is that okay? That means we have cash balance, change in cash, and change in non-cash current assets. So we have all the other items here, current asset items here, except cash. Cash is here. Is that okay? That's what we have done. So we are replacing this with these two. We are expanding this into these two items. And on the left hand side, the change in current liabilities also we expand to two items, which is change in operating current liabilities plus change in non-operating current liabilities. Why do we do that? Because some current liabilities change spontaneously with operations, while others are discretionary. Spontaneous means they change automatically. That refers to operating current liabilities. What is an example of operating current liability? A very good, apt example would be payables. The suppliers that you owe your suppliers. So if your scale of operation increases, okay, then your payables will also increase, meaning you will buy more from your suppliers on credit. Okay, if your scale of operation, if your sales go down, then you would owe less to your suppliers. That means you will buy less from your suppliers on credit. So that is automatic, more or less. That is what we mean by spontaneous. While these other current liabilities are more discretionary. But actually in real practice, in practical terms, in the real world, Spontaneous liabilities are not only payables. It can be items like utility bills that you have to pay. So this will increase with your increase in production, for example. For example, water, electricity, and all that. So all this may change spontaneously. If that's the case, then this liabilities, current liabilities, must also be included as operational current liabilities. Okay, so that is why we have done that. Okay, we separate these current liabilities into two, operating current liabilities and non-operating current liabilities. Alright, so therefore we replace that into equation 10. These two, here we replace this, and also here, therefore we get this change in cash plus change in non-cash current assets. Then this we retain from above. This is change in operating current liabilities plus change in non-operating current liabilities. So we replace this with these two. The rest remain the same. And therefore we get equation 13. Alright. Then what do? We are going to do what we did previously in the previous chapter. We add depreciation on both sides of the equation. Depreciation. Why do we do that? Okay, because the same reason that we did in the previous chapter, because it's a non-cash expense. Okay, depreciation is a non-cash expense. We want to account for cash. Okay, from net income, depreciation was already deducted. So therefore, we add back depreciation to reflect the cash flow rather than the accounting income. And we do it on both sides because we want to maintain the equation. So this is the change in cash in one aspect, assets aspect. This will be the change in cash on the liabilities and equity aspect. This must be the same. This must be true. Alright, so that's what we have done here. We have added depreciation here and we have added depreciation here. Now what we are going to do is we are going to rearrange this equation 14. It's exactly the same equation as 14 here. But what we have done is we rearrange. We express all this in terms of change in cash. Why? Because the intent is, the statement of cash flows intent is to explain the change in the cash balance, okay, by looking at the change in the other items. Okay, so therefore we push all the other items to the right hand side. So this remains on the left. All the other items we push to the right hand side, and of course we rearrange them in more meaningful order. So that's what we have got here. So if we push all the others aside and rearrange, okay, we rearrange this way. So net income comes to the front, then plus depreciation minus change in non-cash current assets minus change in operating current liabilities minus change in net fixed assets plus depreciation. This is within bracket, then plus change in non-operating current liabilities plus change in long-term debt plus change in common stock minus dividend. So that's what we have got here. Also, we know that change in common stock is equals to change in equity minus retained earnings. Therefore, we can replace that here. Change in common stock with these two. Okay, that's what we have done here. But we know that retained earnings, minus retained earnings minus dividend is actually minus net income. Net income is equals to retained earnings plus dividend. Therefore, we can replace this. So there are two possible equations. Equation number 17 or 19. 17 had change in common stock minus dividend. Here you have change in equity minus net income. Alright. So note, now what we are going to do next, once we have expanded, this is the extent of the expansion. We don't expand this further. But now what we do is we reduce the complexity. We try and break this into components, especially the right hand side. The right hand side of the equation. The left hand side we let it remain. The right hand side we break this into components. So the first component is made up of these 4 items, if you like. This, and this item. Yeah, so you can find it here. Net income plus depreciation minus change in non-cash current assets minus change in operating current liabilities. So this is equals to CFO. Yeah, remember this. This is not the same as OCF. Yeah, operating cash flow. Here, the concept is similar, but they are not the same. Yeah, so this is called cash flow operation. Yeah, CF operation. But this means if you interpret this, yeah, the expanded term will be cash flow from operating activity. Yeah, I just put this as CFO. Okay, cash flow from operating activity. Now the next 2 items, change in fixed assets plus depreciation. Yeah, this is termed as CFI, or cash flow from investment activity. Okay, and then the last remaining items, yeah, from here, the 4 items here, change in non-operating current liabilities plus change in long-term debt plus change in common stock minus dividend is equals to cash flow from financing activity. CFF stands for cash flow from financing activity. Or these two items can be replaced with change in equity minus net income. Also means cash flow from financing activity. So there are 2 equations, 2 ways to express the same equation here. Okay, CFF is either this or this. Yeah, we can replace this with this. Yeah. All right. Now we can then say the right hand side. Yeah, we can replace all the long equation into these 3 components. Yeah. So we can say that change in cash must be a result of cash flow from operating activity minus, note this, yeah, minus, not plus, yeah, minus cash flow from investment activity plus cash flow from financing activity. Okay, so that's the brief, yeah, statement of cash flow equation. Alright, so now what we are going to do is we are going to try and derive this cash flow statement, yeah, by looking at an example. Taking an example here, we have a balance sheet sample, yeah, sample balance sheet for a company. The company name is not given, yeah, but it doesn't matter. So in this balance sheet is made up of 2, yeah, 2 balance sheets actually into one. You have the balance sheet for 2018 and also for 2017. So this part is the assets portion. This will be the liabilities, and the bottom one will be the equity. Okay, so these are all in millions of dollars. Yeah, so you're also given the income statement for the same company. Yeah, sample income statement. Okay, you have sales here all the way down to net income. Okay, you're also given this, yeah, EPS, earnings per share. Okay, which is net income divided by number of shares outstanding. So the number of shares outstanding is not directly given, okay, but I'll give you this, yeah, I'll show you this later. Then you are also given dividends per share, yeah, that means the amount of dividend paid per share, or DPS, yeah, this is also known as DPS. Now, you can work this out, yeah, $893 million divided by 4.68, yeah, you should get something like this. Number of shares outstanding would be 190.9 million. Yeah, so you can check back the answer. $893 million divided by 190.9 million shares, you will get $4.68 per share. Okay, so this is not given outright, but you can work this out. Okay? So this is the number of shares outstanding. So you need this to solve for the statement, yeah, of cash flows. Yeah, you want to derive the statement of cash flows. This is how a statement of cash flows look like once you have completed. Yeah, but how do you arrive at this? How do you show this? Okay, so this we will look at, yeah, in a different clip. Yeah, another clip. We will present all the items that we have seen earlier in the balance sheet and also the income statement into Excel. Yeah, we present this in Excel. And then from Excel, we develop this statement of cash flows. So we'll see that